Hey everyone, this is Satya from Peaks to Tails, and today's agenda is overview of SOFR. SOFR is a reference new risk-free rate, or as they call it, alternative reference rate. So we're going to talk about basics of SOFR and some of the key calculations that you need to be aware of. So yeah, this particular topic is being offered as part of Deep Quant Finance course. So just to show you on the website, um, give me a second. If you go to peakstotails.com, we have a course called Deep Quant Finance. As part of this course, we are offering this SOFR regime, which is the new benchmark. So these are the classes that we have already conducted. A few more are remaining. So if you are interested to know details about this new rate, the impact on the valuation and all these things, yeah, you can contact us after this webinar. So I'll share the contact details towards the end. Okay, so back to SOFR. What is the main objective of this particular webinar? I would say there are two main objectives. First and foremost, it is an informative session on this new interest rate benchmark that we have, which is called RFR or ARR. Okay, RFR is risk-free rate. ARR is alternative reference rate. As you all are aware, back in the day, right, once upon a time, we used to have LIBOR for everything, but the industry has shifted. Okay. The purpose of the webinar is twofold. One is it's sort of like a wake-up call um, for everyone who is not aware of SOFR yet, right? Especially FRM and CFA students who are still doing derivative valuation using LIBOR, right? It's time to pivot to SOFR because the industry has already moved to SOFR and we are not using LIBOR anymore, except for a few legacy products that are still using LIBOR as reference rate. Okay, so time to get up to speed and pivot. So that's one. Number two, with SOFR, right, there are a few basic ideas and a few changes in the calculations that you need to be aware of that would help you remove some of the static friction uh, in order to understand the new valuation regime for interest rate derivatives. Okay, so my objective for this webinar is to get you up to speed in terms of the key calculation changes that you have to be mindful of. Okay, there is a fundamental mindset change when you are dealing with LIBOR versus SOFR. So once you absorb that, the rest of the things become easy, right? Whether it's valuation or risk modeling or hedging or whatever have you. Okay, so with that introduction, let's get going. All right. So here is the structure for today's webinar. We are going to talk about a little bit of LIBOR history and LIBOR transition because that background knowledge is important for the concepts to sink in. You need to have a background, right? How was LIBOR calculated and why the transition came into being. Then we'll talk about a little bit about SOFR basics. How is SOFR calculated, published? How is it used? Who are the different bodies and things like that? That this will be a key discussion point for today. If you understand this, it will be very easy for you to, tackle derivative pricing, interest rate curve construction, and things like that. So how do we calculate floating rate under SOFR? Okay, that will be a key topic. I will show you some basic calculations in Excel as well. Then we'll talk about SOFR products and valuation. So with the introduction of SOFR, we have the floodgates of different instruments have opened up, right, which refer to SOFR for valuation. So we are going to talk about some of the key liquid SOFR contracts that are listed by Chicago Mercantile Exchange, CME, right? And how do we value those products? Right? So that is the next agenda. Then I'll touch upon a little bit about the SOFR rate curve. How do we go about creating the yield curve or the zero rate curve for SOFR? primarily looking at the liquid SOFR futures, right? How do we extract the rates and bootstrap the curve? We'll not go into detail. That is covered in detail in the course, but I'll give you the main ideas, how it is, how CME actually calculates it. Okay. Then we'll open up the floor for question and answer. Does that sound like a plan? Any questions? Just want to ensure you guys still can hear me. Are you guys still there? Okay, awesome. All right. So with that, let's proceed. First topic is LIBOR transition. Right. So what is LIBOR? Well, once upon a time, we used to have this fundamental benchmark curve called as LIBOR, London Interbank Offer Rate. And there was a British Bankers Association, BBA, which composed of 16 banks. Number of banks have changed from 16, they have gone to 18 at some point, right? But let's consider there are 16 primary banks that constituted this British Bankers Association. So every day before 11 a.m., they were asked this question: at what rate can you borrow? This is the legal language. I'll let you interpret this, but the question that was asked every day was at what rate you think you can borrow, right? For different maturities. What is the overnight rate? What is the 1 month rate? What is the 3 month rate, right? This question was asked. And the quote that the banks gave had a basic waterfall approach. Okay. First and foremost, the estimate or the quote that they gave should be based on actual transaction. Okay. If you have conducted a lot of transactions for 1 month maturity, then you give that quote. If not, if you don't have enough transactions, then it is based on expert judgment. Okay. Purely based on expert judgment, you give an estimate of what is the rate at which you can borrow. So every bank, you submitted that quote, and then LIBOR was a trimmed mean of those quotes. Okay. So for example, let's say we got 16 quotes from the 16 banks. You remove the top four, remove the bottom four, right? So you trim the outliers. Then for the remaining 8, you take the average. That becomes the LIBOR for that day, which everybody used for various purposes: derivative valuation, risk management, hedging, everything. And you submit the quotes. How many quotes are there? There are actually 35 quotes. So 5 currencies you can see, right? US dollar, GBP, yen, and euro and Swiss franc. Under these 5 currencies for 7 maturities: overnight, 1 week, 1 month, 2 month, 3 months, 6 months, and 1 year. Right? 5 times 7, 35 different quotes. Banks used to submit, take the trimmed average. That's the LIBOR. Okay. Now this system worked very well for probably 4 decades, right? Until a few things started happening. So let's see what happened. So during 2008 crisis, okay. Before that, so this fundamental benchmark rate, LIBOR rate, it's an unsecured rate. Okay, it's not collateralized. It's just a simple estimate of at what rate you could borrow, and that was used for everything to project floating rate cash flows. Right? What is the floating rate based on the LIBOR benchmark? Even for discounting is a fundamental need for valuation. Right? You want to present value cash flows. For discounting, also, ideally, we need a risk-free rate to do a proper valuation of the derivative. But for the risk-free rate, also we are using LIBOR because these top banks were considered default-free, double A rated bank. Nobody ever thought that these banks can default, right? So if they are able to borrow at a certain rate, that must be close to the risk-free rate. There is a little bit of credit component because it is double A rated bank, but it was considered virtually risk-free. So LIBOR was used for everything, for projecting the future floating cash flows, for discounting, for everything, right? During 2008 crisis, what was observed is, if you see this particular graph, till 2008, there was virtually no difference between LIBOR and OIS. OIS is overnight index swap, which referred to the federal effective federal fund rate. Okay, there was no difference. So it did not matter which one you use, right? So everybody used LIBOR. After 2008 crisis, you can see there was a huge spike in the basis. So LIBOR minus OIS, you see the difference. So the basis point between the LIBOR and OIS skyrocketed. So at that moment, everybody realized, hey, LIBOR is not risk-free, right? There is so much difference between OIS and LIBOR. Okay, so this happened. The gap skyrocketed between LIBOR and OIS post 2008 crisis. So a new breed of interest rate valuation came into picture, which is called dual curve or multi curve, right? So LIBOR was still used as a benchmark curve to project floating rate cash flows. A floating rate benchmark. LIBOR was still used as a floating rate benchmark, but for discounting purpose, you need a risk-free rate. And because LIBOR was no longer perceived as risk-free, they started using OIS for discounting. So we entered into a dual curve regime where the numerator, the floating rate cash flows, was based on LIBOR, but the discounting was based on OIS. Okay, and that system worked from 2008 until, let's say, 2016, 17, right? So that system worked, and yeah, so we still continued with LIBOR in this fashion. Then what happened? So here's a picture of Breaking Bad. It's a famous TV series. Not sure how many of you watched it, but yeah. So what was found in 2012 is that the LIBOR rates that were quoted by the banks were being manipulated. Okay. Why are the banks manipulating LIBOR rates? There are two primary reasons. One is, obviously, if you manipulate the rate, it might give you more, it might be profitable or favorable for your book. You know what are the derivative positions you have currently, right? And you know if the LIBOR goes up or goes down, you would either benefit, profit, or suffer a loss. So based on what was favorable to you, accordingly, you either inflated or deflated the LIBOR code. Okay. And the second reason is if you quote lower, that means everybody will perceive that you are more credit worthy. Because the question is, at what rate can you borrow, right? If I quote a lower rate, that means everybody will perceive that I'm more credit worthy. So these were some of the reasons why the banks started colluding among themselves, and they started inflating and deflating the quotes, which was disastrous, right? So multiple criminal settlements. Barclays Bank was fined in the beginning. That's the first bank, and then after that, pretty much all the banks were levied heavy fines, close to $9 billion. So this is the LIBOR scandal that happened. Okay, there is a documentary and a book written on it. So some of the innocent people also got suffered because of this as whistleblowers. Okay. If you get some time, read through this book. Right, it talks about whistleblowers who were jailed after exposing the rotten heart of the financial system. Okay, so LIBOR scandal happened. Then a lot of protocols and governance was put in place, and the system still continued. Okay, this is not the reason why uh, SOFR or the alternative reference rate was introduced. Okay, this is not the reason. After the LIBOR scandal, there was strict governance and protocols that were put in place. The real reason why LIBOR was transitioned is that's in the next slide. So here is the real reason. If I want to summarize, right, the actual transactions that happened based on this LIBOR rate, that volume was actually thinning. Okay, so at one point you can see $200 trillion of notional referenced the LIBOR rate. So this is just a segmentation of different types of products, right? We have mortgage-backed securities, we have Student loans, credit cards, consumer loans, and derivatives. Here are all the derivatives: cross-currency swaps, interest rate options, FRAs, IRS. Is a breakup of all the total $200 trillion notional that we had at one point, 2016. But the actual transactions settlements that were happening based on LIBOR was only $500 million. Okay, so you cannot rely on a rate that has such a very thin market. It's only $500 million average daily trading volume. So that was a major concern. So because of this, now what was happening is banks, remember that waterfall approach? So LIBOR quote that the banks submitted was first based on actual transaction. If there are not enough actual transactions, then you give expert judgment. So what was happening more and more is banks were submitting the expert judgment instead of actual transaction based quote. And obviously, with expert judgment comes biases and things like that, right? So that quotes were not reliable anymore. That's the reason why a new committee was convened called Alternative Reference Rates Committee, ARRC. Back in 2014, so this committee was created to start thinking about another candidate for this benchmark rate or risk-free rate. Yes, liquidity was a concern in LIBOR. Close around 2016, the actual transaction, the daily volume was actually diminishing. Okay, although in the contracts we had the LIBOR as the reference rate for valuation purpose, the actual transactions based on that LIBOR was diminishing. That was the reason. So to combat that, 2014 we had this committee ARRCC, which was responsible for evaluating various different types of rates and coming up with the best rate that suits as the new risk-free benchmark rate that can replace LIBOR. Okay, so they evaluated many different rates. First one is SOFR, obviously, secured overnight funding rate, effective federal fund rate, then overnight bank funding rate. All these rates they evaluated, and then finally they selected SOFR as the alternative rate for USD LIBOR in 2017. Okay, as a series of articles published by ARRCC, I would say please go ahead and read it. You'll get the entire history of different events. Okay, how this came into being. So once SOFR was selected, we need a market for SOFR, right? SOFR is new. I mean, so I'll tell you how SOFR was calculated, but it was not available for the general public to, create contracts around it. So Chicago Mercantile Exchange (CME) started to launch SOFR futures. Okay, 1 month and 3 month SOFR futures. It started listing on their exchange in 2018. And obviously, futures are very liquid, right? So this was to provide enough market depth and price discovery for SOFR rate, right? Once futures start trading, from those future prices, you can infer the rates and you construct your yield curve and do hedging and all these things. Okay, are you guys still able to hear me properly? Okay, maybe some issue with on your side. All right. So 2018, so for 1 month and 3 month futures were listed. Okay, and since then, I'll show you the volume today, it is a lot. Okay, the liquidity of SOFR futures is huge. All right, so after 2018, 2018 April, okay, SOFR, so Federal Reserve Bank of New York, FRBNY, started publishing the SOFR rates. It is there in the website. There is no like black box or ambiguity anymore. Anybody can go to their website and see the published SOFR rates. Okay, I'll show you. 2020, the Federal Reserve Bank of New York started publishing the SOFR averages, moving averages, 30-day moving average, 90-day moving average, 180-day moving average, and also the index. Okay, these moving averages, like 30-day moving average, can serve as a 30-day rate, although it is historical because based on the published rates, right? We calculate the average. I'll show you the calculation. But still, it is like a proxy for a term rate, like 30 days rate, 90 days rate, right? Yeah. And then, so yeah, I'll show you all the calculations. So for calculation, future valuation, everything I'll show you. I'm just telling you the evolution of SOFR, like how it started, where are we right now? Okay. So yeah, SOFR stands for Secure Overnight Funding Rate. Secure Overnight Funding Rate. Okay. Um, so now that SOFR rates were published and futures are listed, trading has started already. What to do with the legacy contracts? Legacy contracts which still had reference to LIBOR, right? There are derivatives. It's let's say 30 years interest rate swaps, for example, which were referencing LIBOR. They are still open in the books, right? We cannot just do away with LIBOR and forget about these trades. So we have to come up with a fallback mechanism, which means how can you still artificially calculate LIBOR to do justice to these open trades, which are still in your books referencing LIBOR, right? So ISDA came up with this fallback approach where I'll show you the exact calculation. So they came up with a way to infer LIBOR. Even if LIBOR is stopped, I can infer the equivalent LIBOR by adding a spread on top of SOFR. That's the idea. You observe SOFR because SOFR is active live, right? And then you add the spread, historical spread, and infer the LIBOR, and then use that LIBOR as a fallback rate for continuing your valuation of derivatives. Okay. Any net new derivatives that you come up with, that must reference SOFR. It cannot be based on LIBOR because LIBOR is done. We are not publishing LIBOR anymore. June 30th was the end of LIBOR. Okay. But to do justice to the trades which are still referencing LIBOR, there is a fallback mechanism where we can infer the LIBOR by adding a spread on top of SOFR. That's the idea. Okay. All right. We'll go through the calculations. Don't worry. Give me a second. Okay. So as I said, right, SOFR is for US dollars. Remember, there are 5 currencies that were part of LIBOR. 5 currencies, 7 maturities. Remember that. That is what LIBOR used to be. With SOFR, so SOFR is again the rate for US dollars. Similarly, other currencies adopted different reference rate. Okay, you can call it risk-free rate or alternative reference rate, ARR, which is not LIBOR, but something else. So for US, we have SOFR, Secure Overnight Funding Rate, which is published by Federal Reserve Bank of New York. It is a secured rate, okay? Because the way we derive SOFR rate is from collateralized repo transactions. Okay, I'll show you the exact calculation, but it's a secured rate, hence the name Secured Overnight Funding Rate. Similarly, other currencies, right? GBP has Sonia. They had Sonia, but now Sonia is reformed, so they are using that. We have Ester, European short-term rate for euro. It is non-secured, and Saran for Swiss franc, which is secured, and Tonar for Japanese yen, which is unsecured. So across the major currencies, 5 currencies, everybody moved away from LIBOR and they have adopted alternative reference rate, and these are the alternative reference rates. All right. Okay. I'm still getting questions that the voice is low. How is the voice, everybody? I just want to take a quick poll. Is it audible, clear? I just want to ensure nothing wrong with my side. Crystal clear. Okay, awesome. All right, let's move on.